Hi, I'm Lucas Miller from Bannock Capital. Thanks for joining me today. Today I want to talk to you a little bit about structuring a multifamily syndication deal. Now, there's a lot of different parts that go into these complex multifamily deals, but it really doesn't have to be that complicated. There's a few key items that you should understand if you plan to passively invest in a deal, and I'll take you through those one by one. One of the most common questions I get is, what kind of returns am I going to look at if I invest in your deal? Well, that's a complicated question to answer simply because multifamily is so complex and the returns come in different areas. It could come in year one, it could come in year 6, year 7. It just depends on what type of deal it is. So you have to really understand what you're buying into on the front end. Now, as an investor, you need to answer a few questions of your own. Am I interested in cash flow, or am I interested in a larger equity on the back end? Those are two very different types of deals. If you're counting on cash flow, but a deep multi-value add is what you invested in, you might not see cash flow for the first year, 2 years, maybe even 3 years. But if you're looking for equity on the back end, say in year 5 or 6, that's the perfect deal for that because the value will be added and then you'll realize that gain on the back end. So let's start with something obvious: cash on cash return. This is something most real estate investors understand, but just in case you don't, cash on cash return is this very simple metric that takes into account your return unleveraged. So what that means is if you were to buy one of these assets all cash, here's the number that you're probably going to achieve on a yearly basis. Now, these are usually somewhere between 8 to 10, 11, maybe even 12% sometimes. So the higher the cash on cash return, the better your cash on cash return would be. The better your unleveraged ROI would be. So if you were to buy an asset for $1 million, let's say, and you have a 10% cash on cash return, $100,000 a year is what you can expect in your income. One of my favorite metrics for understanding the ROI of a multifamily syndication is what's called an internal rate of return, or IRR. Now, this is a complex financial return metric that you don't have to understand the complexity of it. You just have to understand that it takes into account the time value of your dollars. Now, this is important because I can offer you 100% or 200% ROI, but if it takes me 10, 20, 30 years to achieve that, it's not a great value of your dollar because you could take those dollars and invest it somewhere else in that time and make better return. So IRR is an important metric to understand when is the best time to dispose of the asset and realize your gains. Generally, at Bannock Capital, we want to shoot for something in the ballpark of 14 to 18, maybe even 20% IRR. Though on the higher end of that scale is a really good metric, but all you really need to understand is a 15% IRR over 5.5 to 6 years generally. That's projected to double your money. So that's a really good way to understand that value. Speaking of returns, let's talk about how I would get paid. It's important for investors and limited partners to understand how everybody gets paid in this pie because you never want to have a misalignment of interests. Now, Bannock Capital generally shoots for deals that are split with the equity somewhere around 70-30 or 80-20. This means that 70 or 80% of the equity would go to the limited partners. 20 to 30% of that would be reserved for the general partnership. Now, what that means is you're taking the most risk by putting up your capital. We're taking a significant amount of risk on the general partnership by putting up earnest money deposits, reputations, due diligence costs, things like getting inspection, bank fees, lender authorization fees, things like that that take significant amount of capital but will be returned to us. So the risk is really on the limited partners, but the work is on the general partners. Now to how I get paid as a general partner. There's a couple different ways that you can make money on the general partnership side, but the main ones are cash flow, acquisition fee, and asset management fee. The acquisition fee is repayment on the front end for finding the deal, negotiating the deal, and securing it for our investors. Think of it as payment for orchestrating the entire project. This is generally between 1 and 3% of the purchase price of the deal. Cash flow is a little different. Just like you receive cash flow, the general partnership will receive cash flow as well. 20 to 30 cents for every dollar the property brings in. The other going to you. Now, the asset management fee is a little different. That's for the long-term upkeep of this project. So you want your asset managers to be involved in your deal to make sure it continues to meet your metrics, to continue to provide cash flow. For that, they receive probably around 0.5% to 1.5% of gross rents in the form of a fee. That's for the monthly upkeep, for keeping things running and making sure that the management company is doing their job. Now, the beautiful thing about commercial multifamily is there are very few rules on how a deal can be structured. So you might see a deal with no preferred return, but a very high acquisition fee, or maybe no asset management fee or no acquisition fee, but a high equity split for the partners. So 50-50 maybe. It really just depends on what's best for investors and how everyone gets paid. Now, you want your general partnership to get paid. Sometimes people say, oh, I don't want you to get that much money. But in reality, you're working against yourself by having a misalignment of issues. I want to make money, you want to make money, and we want to make money together. And so the best way to do that is make sure everyone is evenly compensated in the deal. These are some of the most important metrics and ideas you need to understand about multifamily investing, but it's not everything. It would take too long to explain everything that goes into one of these deals. That's why I encourage you to come set up a call. Let's have coffee. Let's get together over a webinar and talk about some of these things. You need to do the research on your end to make sure you're involved in a deal that fits your investment metrics. And I need to do my due diligence in teaching you how these deals go together. So let's meet, let's have coffee, let's talk to each other, or I can point you in the direction of someone that might be able to help you better. Now, I just want everybody to be successful. So whether you're investing in the stock market, syndications, Bitcoin, or gold, whatever you decide you want to invest in, I'd love to help you in any way I can. This is my specialty, so this is what I encourage everyone to take part in. But you need to do your own research as well. Investing in syndications is serious business, and you need to understand the metrics that go into this. I hope this video was helpful for you, but if I can answer any other questions, please let me know. Thank you.